Hi everyone, this is Xavier. Today I'll be sharing with you what kind of loan should you be getting when purchasing your HDB. So there are two types of loan. The first one would be your HDB loan and the second one would be your bank loan. So let's take a look at the both of them and see which one should you be getting. So before diving into the HDB loan, let's run through what are the eligibility criteria for it first. So the first criteria is that at least one buyer is a Singapore citizen. The second criteria is that you have not taken 2 or more loans from HDB and your last owned property is not a private property. The third criteria is that the average household gross income should not exceed 7,000 for singles and 14,000 for family and 21,000 for extended family. The fourth criteria is that you have no private property or have disposed of it 30 months before the date of application for your HDB loan eligibility letter. And the last criteria is you do not own more than one market store, industrial or commercial property. To find out more about the eligibility requirement, I'll post a link below in the description. So one very important thing to take note of is to find out what is the maximum amount you can get even before looking for your first HDB flat. The maximum amount you can loan is up to a certain percentage of the flat's purchase price or the market value, whichever is lower. However, other factors such as your age as well as your financial status do play a part to determine whether you can get the maximum amount loaned to you. To find out the maximum amount you can loan from HDB, simply to apply the HDB eligibility letter, otherwise known as HLE. It will tell you the maximum amount you can get. As for a bank loan, simply just apply for approval in principle from whichever bank you are looking to loan for, and it will tell you the maximum amount that particular bank is willing to loan you. So, the biggest consideration between HDB and the bank will definitely be their interest rates. So the HDB interest rate right now is currently at 2.6%, whereas for the bank is about 1.3 to 1.7% for the first 3 to 5 years, after which usually the rates will increase. And also the bank offers 3 different types of loans for you to choose from. So the first kind of loan that the bank offers is called your fixed interest rate loan. The rates will be the same, ranging from 1 to 5 years. The second kind is called floating rate packages. So the rates will be different at various years. The lock-in period will also be different, as well as the minimum based on the minimum loan amount you are looking for. The third option that you can go for is a combination of both the fixed as well as the floating. At first glance, bank rates will definitely look more attractive than HDB as it is much lower, but do take note that in the past, bank rates do went up to 3 to 4%, which is much higher than HDB. Bank rates have remained low only because after 2008 financial crisis and went down even further because of this year's 2020 COVID-19 situation. So if you're someone that likes to play it safe, HDB will be better for you as it has stability. But if you're someone that likes risk and reward, then bank loans will be more suitable for you. The next difference between the two would be the cash down payment, or rather down payment. For HDB, you only need to pay 10% down payment, and if you have significant money in your CPF OA, you actually don't even need to come out with any cash. Whereas for the bank, you need to come out with 25% down payment and 5% has to be in cash. So the third difference between the two would be the loan to value limit, or LTV for short. As I have mentioned earlier in the video, LTV is basically the maximum amount in terms of percentage you can get based on the flat's purchase price or market value, whichever is lower. If your loan is from HDB, you can get up to 90%, but if you're getting from the bank, then you only can get up to 75%. The next difference between the two loans would be early repayment. For HDB, there's no early repayment penalty if you want to incur less interest during your loan. But for bank, there's usually a 1.5% charge for early repayment. So the next point is refinancing. Refinancing basically means taking out a new loan to pay off your original mortgage loan. The reason why many people will want to do this is because they want to take advantage of lower interest rates. If your first loan is with HDB, you can always refinance it with a bank loan at any time as there's no lock-in period. But if you were to start off with the bank loan, then be very careful, because once you start off with the bank, you only can refinance it with other banks. You cannot go refinance it with HDB loan. So be very careful which one you choose to start off first. Another alternative for bank refinancing would be repricing. So what is repricing? Repricing is basically getting a better interest rate package from the bank that you're already currently working with, instead of refinancing it with another bank. One good financial tip for you is to consider refinancing every 3 to 5 years or immediately after your lock-in period. But if the difference is only 0.5%, then I won't recommend you to do it because there'll be costs involved and it's so much of a hassle and probably won't even save much. And the last point would be late repayment. HDB only charge you a 7.5% per annum in terms of late repayment, but the bank won't be as kind. They will definitely charge higher than that. I hope this video have given you a better understanding about bank and HDB loans. If you find that my video is helpful, don't forget to like and subscribe below. I will be uploading new videos every week on this channel.